Good morning and welcome this morning to Trader Talks in Today's Market, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. There is the bell. That means that the market is up and alive. And so is my good friend, Michael Fairborn. Good morning, Michael. How are you?
Doing well, Ben. Good to be back with you.
Hey, it's been a while since you and I have been on a show together. We've been on the live stage a couple of times together, but thank you for being here. Thanks to all of you for joining us this morning. And also out there in the chat is our good friend, Barb Armstrong, phenomenal educator and 20-plus year veteran of the financial markets, which means that she started when she was about 6 years old. But she's going to be out there helping answer your questions out there in the chat. She is there for your support to help answer your questions. Thanks for joining us if you're here in the live version or in the recorded version. We are glad to have you with us this morning. Michael, it's going to be an interesting day. The market kind of moving a little bit on interest rates and some earnings news and some other things. So what do you say we just get right into it here after a couple of quick housekeeping items? Huh?
Sounds great, Ben. Yep, looking forward to it.
All right. So a couple of things we need to talk about really quickly here. First of all is that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice. Also remember that investing involves risk, including the loss of principal. Past performance, no guarantee future results. Options carry a high level of risk. They're not suitable for investors. We're not going to talk about options in this discussion today, but I just want to make you aware. Again, if you happen to see options content or we happen to mention anything about the VIX or anything like that, remember that you need to read and understand the characteristics and risks of standardized options before considering any option strategy. Lots of different ways to look at the market, fundamental analysis. I know something Michael talks about, probability analysis, technical analysis. They are all theoretical in nature. None of those are guaranteed. They don't reflect any degree of certainty as to what the market might do. And because of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we are going to be using the Thinkorswim desktop software platform today, specifically the paper money version. It is a great learning environment. It's a great sandbox for exploring ideas and practicing. However, it's not a guarantee future success out there in the real world. And it doesn't do a few things that a live trading account will do and behave. So when you move your practice from paper trading to live trading, make sure that you're aware of some of those differences as things happen. So Michael, I'm going to shift our view over here to the Thinkorswim desktop software platform. And as I do this is a good opportunity for us to remind everybody to click on that subscribe button down at the bottom of the page, right?
Absolutely. Yep. Love to have you on board. Great time. And you get that, you get those feeds coming up regularly when you sign into YouTube. So it's a great, easy thing to do.
For sure, and it's at no cost to you. So do that. You can follow us also on X at Ben Watson CS, at Mike Fairborn CS, at Barb Armstrong CS. We'd love to have you over there as well. And if you like what you're seeing today in this webcast, go ahead and click on that like button. That's going to pop this up to the top of the algorithm. That's going to help other people out. What I don't know, Michael, that's helping other people out, maybe traders today, is the fact that the market is opening down a little bit here in the major indexes. The SPX down this morning about 0.5% right off the bat as we see it kind of coming back into the support level. And we can kind of see this as we go across the screen here. The NASDAQ down, but a little bit of a rally. So coming up off of that little bit of a gap down, and the Russell 2000 gapping down to the bottom of the range, but starting to see a little bit of performance to the upside. I know interest rates, Michael, are one of the reasons why we might be seeing this, but what else perhaps might be on the radar this morning?
Well, we've got a few things, Ben. And what's interesting too is we are seeing a little bit of a rotation in possibly back into some of the precious metals as well. You've got some of the gold and other products out there that have been doing actually a little bit better. They've actually held up. Gold and gold miners have held up a little bit. There could be somewhat of a normal, natural sort of rotation that we could be seeing as well across the board. You can see gold. Gold didn't really pull back too much as we look at that right there. GC, I mean, in terms of the bigger pullback, but yet it held its ground and started to come back up again a little bit. I think, we had a really good run. In fact, a number of just in terms of a winning streak on the S&P 500, it was very, very solid. But gold didn't pull back as much, and we're starting to recover there. I was
Sure.
actually tracking that a little bit with some of the gold miners, Ben.
Yeah, so I just want to make mention of this really quickly as we look at this particular chart. This is a chart of the gold futures contract. Now, we're not talking about trading futures in this discussion. We're simply using this as a measure of one aspect, one asset class in the market. And if you want to learn more about trading futures, Michael and I can accommodate you on Tuesday mornings, this same time frame. We talk about trading futures. Michael's usually in chat when I'm not around. He's there covering the webcast for me. So we're glad to have some of that discussion. But again, as we look at any futures contracts this morning, these are not simply for the looking at trading these instruments. We're simply using these as measures of the market, right, Mike?
Exactly right, Ben. Yep.
So what are some of the gold miners while we're here on this particular chart? What are some of those gold miners that you've been looking at? I know one that's sometimes talked about is Barrick.
They changed the symbol to B, by the way. For
some reason, it's not coming up for me here.
They changed the symbol to
There
B.
are a lot of other ETFs, and we're not going to talk ETFs in this discussion. Again, that's Kevin talking about ETFs on Friday in this webcast, right, Michael?
That's exactly right, Ben. Barrick is now symbol B, but just a recent change. But you're right, Barrick's in there. The leader of the group, pretty much been across the board, has been Agnico Eagle, which is AEM.
There we go.
Yeah.
Right here.
In terms of a longer term trend, and that might be a trend that could be reestablishing itself, perhaps. It's been a very long upward trend, probably a 2-year, year and a half, 2-year rally to the upside there. And you can see, Ben, that it may have come back down. And many of these have dipped a little bit, perhaps rested on prior highs, established a base. And we'll see, oftentimes in these cases, a lot of times traders are waiting for a close above the high of the low day. We have that. Maybe a trend line break. We're very close to getting that off of the top end coming down, drawing it off the tops there. But yeah, exactly. And maybe we just barely got it.
We might have it today.
Yeah, maybe today it closes there. But this might be a general theme across the board. But this, Ben, has been one of the leaders. One of the laggers actually has been Barrick. But so
we'll come back and we'll take a look at B and Barrick again. But you can kind of see that downward channel. And this is what I was kind of seeing on that futures contract is there's this little bit of a downward channel going on in the miners. But, this is reflective. And again, kind of that rotation to safety, right? And we've talked a little bit about this. I know you talk about this on, I think it's Wednesday afternoons, right? In your market and sector analysis webcast. And I talk about it on Fridays in the Market Movers webcast is kind of where things rotate to in terms of that perspective of perceived safety or kind of safe harbor, right? Not necessarily that moving into gold or gold miners is safe. Safe is obviously a relative term, but you talk about it in terms of moving to things like that are more defensive or that move in a different fashion than, say, the rest of the market, right?
That's exactly right. And there can be kind of that offset, that rotation we've seen. Sometimes we see that with treasuries as well. I know like treasuries hit I think it was, I want to say 5% today. And a lot of times when that happens too, just getting back to your original point, Ben, there can be an additional push. It might have been the 30, if I'm not mistaken, that hit the 5. But you can see
so let's do this. So this is the micro 10-year yield future. So this is what's oftentimes used to measure that 10-year yield, the interest rate, if you will, right? And this is the one that governs things like mortgage rates for the most part, auto loans, sometimes credit card loans. But when we talk about longer term debt, right, we talk about kind of that safety play, then we could use something like TYX, but you have to go TYX colon CGI, and you're right. If we were to move the decimal point over here, we are above the 50, that 5% level, right? So move that decimal one over to the left, and it's 5.0, and that gives you the rate here. And this is moving to new recent. This is a 1-year daily chart. New recent highs, right?
Exactly, Ben. Yeah, and the higher that gets, and that's a great point you bring up because it did take out those highs. That's going to attract attention. And with that, from investors, I mean, you're getting higher yields there. At the same time, the market has had such this a very long winning streak off of its recent lows, right? So the combination of the two could also help, perhaps, the market, maybe turn over a little bit. Maybe we'll seek for some support, some shorter term
Yeah.
support, maybe on a possible pullback is what some traders could be looking at, Ben.
So this is a 3-year weekly chart of the TYX with a 30-year interest rate. And you can see where that recent high in the last 3 years was notched up around that 5.1%, 5.16 thereabouts. And that was back in October of 23. We saw that move to that high point and then a little bit of a pullback. But since then, it's really kind of been making that rebound back towards that range. If we take a look again at the TNX colon CGI, that's where we get that 10-year note as opposed to the futures contract. And you can see that this is maybe falling off a little bit more. It notched that 5% level about the same time, that October timeframe, but it's fallen off a little bit. It's now currently sitting at about 4.5. We know, Michael, we have another Fed meeting coming up in just a couple of weeks. That first couple of weeks of June, we're going to see that Fed meeting coming out. Again, there's some growing expectation of Fed movement potentially, but at the same time, the last Fed meeting, their conversation, the press conference, all suggested maybe again waiting to see what the data suggests. Yeah.
Exactly. Yeah, I think a lot of that, to your point, Brent, bringing all that the discussion, FOMC meeting. I think it was that they were anticipating still kind of holding through that time frame, through the
Right.
June time frame as well, if I'm not mistaken. Yeah. And
So
with
this is going to be
expectations
interesting, right? I
building.
mean, this is an
Yeah.
interesting perspective because as this has changed, this has caused some of that rotation. It's also been one of the areas that has impacted, as we talked about this, Michael, the small caps. I want to come back to our index grid here really quickly and come back over to our small caps. And we can kind of see what's been going on in terms of small caps. They've been lagging a little bit in terms of the performance outright relative to other segments of the market. The SPX, kind of the broad market, the NASDAQ, the tech heavy segment of the market, the small caps running perhaps into a little bit of a resistance level here, right around that 2100 level, and now kind of pulling back just a little bit after that gap up. But this is what I've been noticing on really all of these indexes and including the Russell 2000, a bit of a bearish divergence at the moment with the RSI. The RSI kind of falling off, we're seeing maybe that oomph behind this upward move kind of subsiding a little bit at these resistance levels. What do you think here in terms of this perspective? Do we see a pullback back down, say, for instance, to, in this case, the 50-period moving average, where it has had a hard time breaking through on the small caps, or do we see it maybe moving back towards the 200, which it has not yet broken through, which the other two indexes have?
Yeah, it's an interesting point, isn't it, Ben? Because it has been a laggard. We could see on the chart too, totally distinct and different from, let's say, the S&P 500 index or the NASDAQ. We can see clearly here on the Russell, lower lows and lower highs, a clear trend to the downside. But it is interesting, Ben, that we made it back up to the 2100 level and we've just flattened out right there. So flattening out right at prior highs, it's starting to look a little bit like a flag pattern. It's just going sideways there. And all else equal, if it can hold at least this tighter range, or let's say the last week or so that it's been holding there, Ben, I would be, it could be fascinating to see if we break up a little bit higher, particularly if there is an interest rate cut that does occur. We know that small cap stocks have higher borrowing costs. That could be a positive move there. But
Sure.
It's really interesting is it is holding the prior run up very, very nicely.
Now, one thing I wanted to look at here really quickly, Michael, I'm going to change my grid, and this is one that I use quite often on Fridays in the Market Movers webcast. And I know you've talked about this before because we've had this conversation, but this is the S&P 500 relative to the moving averages, right? So relative to the 200-period moving average, relative to the 100-period moving average, relative to the 50-period moving average. And if you think about it in terms of timeframes and how we teach them and how we talk about them, say, for instance, in our live workshops, The 200 period moving average is kind of that long-term perspective from longer-term investors, institutions. The 100 period moving average is kind of that intermediate time frame in this particular perspective. And then that 50 period moving average is kind of that shorter term, short to intermediate time frame, because it spans about a quarter and then about a half a year and then about a full year, right?
Right.
So this is showing the percentage of stocks within the SPX that are above those respective moving averages. And what this little hook tells me is that this is changing, at least in the near term, starting to see some of them come back, maybe some earnings driven pullbacks in these cases. But the fact that we've got more, so we see this green line, the percentage above the 50 period simple moving average being above the objective SPX line, that tells me that the majority of the stocks within this index are above their 50 period moving average. And that would be suggestive of some pretty strong breadth, not nearly as many above the 200 period moving average. And that's reflective of this deep pullback that we've seen over the last few months, right?
That's right. That's right. So I love your comment on breadth, because the more breadth that you do get, it's likely to maybe help that trend to establish itself in terms of the longer term trend.
Sure.
But that comes back to your initial point. How does that stand relative to the 200-day moving average, right, Ben? We're looking at the
Yep.
longer term trends. We can see the shorter term trends, and that's a positive indication. But getting those longer term trends is what we actually need, particularly on a breadth level, right? To keep
Yep.
that trend continuing to make higher highs and higher lows. The one thing we did see on the SPX, which is interesting, is that recent pullback, we got above the 61.8 level of the fib in terms of a pullback. A lot of traders will look at that as a continuation of the trend. But I think this view of breadth is really, really interesting, because that gives you a sense of, okay, the S&P is there, but how about the whole basket of companies of the S&P?
Sure, exactly. So we can take a look at where that SPX is, because I've got it right here. Here's the 200 period, here's the 100 period, and you can kind of see again that strength moving higher here in this in kind of the broad market index here. So a couple of people asking, can we share this? And so I'm going to do this really quickly. I've shared it, and it's in the description of the Market Movers webcast on Friday afternoons. But let me go ahead and share this. And I know a couple of people are asking this question, so we'll go ahead and put it out here. But remember, any shared items are simply for illustrative and educational purposes only. They are not guaranteed as to time or accuracy. And if you want a really quick primer on how to import and how to install these shared items, our good friend Barb Armstrong, who's out here in the chat helping us out, and I'll let her go and find the link to this. But I know she's got one of her phenomenal short videos that she does on our webcast channel that describes how to import and install those shared items into your Thinkorswim platform. So I'll let Barb throw that out there. But remember, not guaranteed by any means, right? So, Michael, let's do this. Let's pivot over here really quickly to from kind of that breadth, and let's kind of keep this kind of top-down focus. We're kind of narrowing our way down the funnel here. So, what I wanted to do really quickly is I wanted to take a look at our sector index grid, and I know you use something very similar to this in your market and sector analysis. But this is one that I've put together. I use this in some of our live events, like the Market Drive event. We've got one coming up, by the way, in Miami in mid-June. So we'd love to see you there as well. But this is just kind of taking a look at those different sectors of the S&P 500. And on there, the blue line, you can see the names kind of peeking through. I've got to adjust the size of those labels. But the blue line is the 50 period moving average, right? So that can give us an idea as to the direction of each one of these segments of the market. And what's really been interesting to me, Michael, is two things. One, this little hook right here on consumer discretionary versus the pullback in consumer staples. And this little hook right here back to the upside in industrials. What do you make of that kind of disparity? I'll bring up industrials here and we'll take a look at the fuller picture here.
Oh, interesting. Yeah, a lot of times, Ben, and I did see technology too, just on the corner of
Yeah.
my eye. I caught a little hook there as well. Just,
Yep.
you know, looking at those hooks there, in terms of those reversals. And a lot of times it's the technology stocks. It can be clearly the discretionaries as well. I know you pointed out that one too, that they do get a little bit more, if there is more strength coming through in the economy. I know in the news flow, there's been some positive indications on the tariffs. We're still waiting for the bulk of that news to come out. But if there is that anticipation that can unfold, well, that could be kind of influencing those groups. Those did get hit the worst over the last pullback early in the earlier part of this year, particularly with the tariff talks. But now we're starting to see that. Yeah, look at that. That's actually a really big hook on industrials that have been all the way up to the prior high. That might be the biggest recovery of all because I didn't see anything else quite to the prior highs, at least
Right.
on an annual basis, Ben.
Well, and if you think about it, there's two things that might be in the mix here, right, Michael? And you mentioned one of those was the impact from tariffs, but that's kind of multifaceted here. One, those companies that are maybe re-onshoring manufacturing, a lot of those exist obviously here within the industrial segment. And you also have within industrial some kind of quasi consumer discretionaries like the airlines that also fall within industrial. So they're kind of a different read. But you got to think that if companies are re-onshoring manufacturing, it's going to benefit industrials not just from those companies spending more themselves, right? And kind of seeing that potential for shift, but also industrials as the pieces and parts of other companies pivoting to re-onshoring manufacturing and other ideas. So CapEx spending on durable goods, machinery, tooling, that kind of stuff, that's coming home to hit right here in the industrials. And so that additional CapEx spending is driving some of these segments of the market higher, right?
Yeah, that's right. That's a really, really good point. And particularly, you hear Ben, just recently, I think a few trillion dollars actually of investment that
Sure.
can make, a huge impact. And then in addition, quite a bit done with the auto industry as well. So
Yep.
right there. Right there.
So let's kind of just jump forward here. This is consumer discretionary, and we're starting to see this. Now, the reason I bring this up is we see a little bit of a downward move. This looks a lot like the small caps, right, in terms of the move to the downside. But I know that in the discretionary space, we've got a couple of pretty big name earnings, especially today, that have impacted this market. So I wanted to kind of pivot to those. But before we get into specifically some of those earnings, because I know we've got a lot of individual stocks that we want to talk about here in this particular case, I want to come back over here to the Market Watch tab, and I want to go to the Visualize sub tab. And we talked about the fact that the S&P 500 kind of giving us that little bit of a gap down and a bit of a sell-off this morning. We can kind of see where some of that is coming home to roost in those consumer discretionaries. Amazon getting hit a little bit here. The one that specifically that I was thinking of was Target in the consumer discretionary space. But you're kind of seeing it kind of across the board in discretionary and healthcare, even in industrials. Although you've got some in industrials that are doing pretty well. GE Vernova, which is their power division, not their aerospace division. You've got GE Aerospace also moving higher as well. We've got L3 and others within that industrial space. But boy, I know you had mentioned technology. Technology and communication services kind of almost sometimes go hand in hand. Google, the Googles themselves, the combined two symbols there for Google, Meta, all making a big move to the upside, as is AMD, right? Seeing some movement in the chip space.
That's right. The chips. Yeah, chips are very interesting too. And some recent investment into chips. There's some discussion, major investments in terms of like NVIDIA, as well as AMD from the Saudi government. Some big announcements there in terms of big data, and those are up as well, Ben. But yeah, a lot of these, like for example, Meta, a
Yep.
stronger upward move, but then a very, very mild sort of a pullback. Almost some of those mini flags forming on a few of these, Ben, perhaps.
Yeah, absolutely. So, and again, Carol reminding me Target falls technically under consumer staples. You got to think, and again, I mean, consumer Target, Walmart, depending on how they segment themselves and how they align themselves, could be considered to be consumer discretionary, consumer staples. This is the taxonomy is reported by, the structure of the GIS, kind of that general information about how a company identifies themselves. But we take a look at something like a Target, for instance, here, and they are down. This is the one that I wanted to kind of look at really quickly here. Percent down, about almost 6.5% today on this earnings announcement. So, Michael, let's do this. Let's pop over here. I'm going to bring us back to our single grid, just our sandbox that we can look at individual stocks here. And I'm going to take a look at Target in this space. And we see that down move on the earnings announcement. But, what's interesting here is that this is not quite as bad a move to the downside as potentially, I think, A, it could have been, and B, has been in the past, right?
That's right. That's right. You can see, Ben, just on this chart that you have here, on that just a year basis. I mean, these are a few different sort of like bear flags, right, coming down that we've seen. And this is like no different, although maybe it can find, to your point, maybe the pullback's not going to be as big. Maybe we'll consolidate, maybe form a little bit of a saucer type bottom, or at least a consolidation period over time. Because to your point, Ben, we are at lower levels here. And we have been going sideways for quite a while, haven't we? We've been holding this range.
For sure. What I want to do really quickly, I've got implied volatility on here, but what I want to do is I want to change that indicator out with this one. And this is just simply the RSI. Now, there is no one best indicator. This is just simply an indicator that helps us to see kind of that market sentiment, if you will, that momentum. And you can see what I thought was really kind of interesting here is that going into this earnings announcement, you mentioned this saucer bottom, really kind of flat, consumer discretionary, and the question of, will they get hit by tariff impacts? Will they not get hit by tariff impacts? How's that going to come home to roost? Other political issues in the space as well. But you saw that really kind of solid upward movement in the RSI, where buyers were stepping in. They were pushing these prices closer to those highs. Never really broke it out of that resistance level at about the 101 level, the 102 level. But now we get this pullback on the earnings announcement. And despite the fact that this was a, pretty, well, at least, actual was 1.3 versus an estimate of 1.64 on the top line, call that a miss. You start to see this pullback, but not nearly as bad a pullback, perhaps even as we saw like 3 quarters ago. Not that past performance is any indication of what's going to happen in the future, but this might just simply be a little bit of a gap down into a support level, Michael.
Yeah. Hey, Ben, there's lower levels, to your point. What we can oftentimes find is value that starts to come into the equation as well.
Sure.
Not only might they be getting a better feel on what's happening on how to work with these tariffs going forward, because part of that earnings announcement, Ben, is yes, okay, we know what they reported recently, but sometimes it comes down to guidance as well. And Target's one of those big companies that could take a little bit more time to figure it out. But yes, we're tapping in possibly to that value portion of the equation where, hey, it could be a good value here, particularly if we can hold this range in terms of earnings and perhaps even a recovery here. Maybe some of that will be mentioned on the conference call today.
Could be, as a matter of fact. By the way, if you want to know where to get that information, where to find that information about the conference call, you can actually, if you right-click on that icon on the chart, you can go to the company's website, you can read the press release, and in some cases, this is not available on all symbols, but in some cases, you can actually click to a link to listen online if the company publishes that information to listen to that conference call. Now, one thing I've got to mention, if you do that here from the platform, remember, Thinkorswim, the Thinkorswim platform has nothing to do with conference call. Charles Schwab has nothing to do with the conference call. That's third-party information coming from the company itself. That's not us. That's not, our analysis or anything else. That's simply the information that's coming from the company so that you know where that is coming from. But that's kind of cool that you can do that right here on the chart, and that is just click on that icon, right-click on the icon, and you can get that information about the earnings announcement. You can also see that from the calendar or from your market watch, from your watch list. When you see those symbols, the little icons, the phone and the light bulb icon, makes it nice and easy to be able to get that information. So, Michael, let's do this. Let's pivot over now that we've seen the earnings going on here. One of those stocks that we saw in the communications and the technology space that you mentioned was this one, META, Meta. And coming out of their earnings announcement, whoops, that's not what I want. Let's go to Meta and hit enter. There we go. There's Meta. We saw kind of that double bottom and this little bit of a rally up. And you mentioned flag, that kind of flag pattern. And I know Barb Armstrong, who's out there in the chat, teaches a webcast called Trading Price Patterns. And this is one of the price patterns that she talks about oftentimes, is this idea of a flag. Kind of have this little, what we might refer to as a bull flat going on here, don't we?
We do. It's just kind of flattening out. We've seen a little bit of a tendency with the recent trend as well, Ben. You get a little bit of a move up to the upside a few days back, kind of a consolidation, but we had broken some prior highs here, as we could see. Just looking back, I'm just following your horizontal line going back, and we might be actually holding at a prior high as we're flattening out. But really, when you see these flags, Ben, ultimately you're keeping a lot of that range because you're flattening out, but you've kept that big price run up. Those collectively are positive.
Yeah, and the fact that the RSI not really dropping to new lows here, I mean, it's kind of pulling back a little bit, but it's really flattening out, echoing price would suggest that maybe this is kind of that wait and see perspective on things. So a trader might then, in that particular case, as we draw, some of these levels of resistance in terms of looking at these price patterns, like Barb Armstrong talks about in her webcast, this is an opportunity for traders to use things like conditional orders or buy stop orders to create a setup for a circumstance that happens. I know that one of the things that happens is that traders oftentimes can't be in front of their Thinkorswim platform all the time. I know it as shameful as that is, right? I mean, we have other things that we need to do, but we could set up an order here, Michael, to enter a trade on this stock, even if we're not sitting here watching this at the moment, right?
That's right. And I love where that position is at, because you're right at that possible resistance, short-term resistance level. Looks like we're actually maybe even taking that out a little bit today.
Could be starting to move. So what I'm going to do is I'm going to right-click here on the chart, and I'm just going to create an order I'm going to do a buy custom order here with a stop. So looking at getting into this trend and keeping this trend going, and we're going to keep this initial entry. Again, the idea is you don't have to enter a full position. Every time you enter a trade, you can leg into the trade or scale into the trade in terms of adding once your position is confirmed, or once your bias and an opinion is confirmed. So what I'm going to look at doing here in this particular case is we're going to create a buy stop order. And that buy stop order, we're going to trigger just right off of this 640 level. So that's just about 640. We're at 640.30 here. It's kind of moving back and forth. So I'm going to look at like 641, Michael, as the trigger for this buy stop order. It says, fine, if this price goes above 641, then enter the trade. And I'm going to change that to a stop. It says stop, wait, don't do anything until the price gets to that level, then enter the trade, else don't do anything, just wait. And I'm going to leave that as a day order. We'll see if this fills today in this particular case. But then I'm going to put a stop order just below this low in this little bit of a pullback, right? About this 618 mark. So I'm going to come back down here to the stop, and I'm going to say at 618, then get out of the trade. Now, the thing to keep in mind here is that we can specify on both of these cases, both the buy stop and the sell stop order, we can specify the trigger price, but not the execution price, right?
That's right. That's exactly right, Ben. It'll initiate the order, right? And it goes to
correct. So I'm going to make this good till canceled on the stop so that we don't have to come back and recreate it. The other thing I'm going to do over here, Michael, is I'm going to come over and I'm going to specify the number of shares to buy and sell. So I'm going to, if my total position was 100 shares, I'm going to create this order as 50 shares to begin with. And I'm going to close that little lock right here so that if I'm getting into 50, I'm getting out of 50. so that those are the same. But then, say for instance, a trader might, if the price of the stock now goes up above that previous high, add to this position if it continues to move higher and come back to kind of filling that into that full 100 share position if it continues to move to the upside. And that way, you're keeping risk small on the initial move. You've got a stop in place. It's not that that guarantees at what price this is going to get filled, but it manages the risk and defines where that exit would be. And then looking at adding to the position if the price of the stock goes higher, right?
That's right, Ben. And a lot of these stocks are expensive these days. They've been going up for a while. Plenty of them have, and so cutting that down to 50 can make a lot of sense. It's just a good catch there.
You know, one of the things to think about, and this is a conversation that Barb Armstrong has in the webcast that she teaches on a regular basis called trading a smaller account, is, you know, you think about the cost of this trade, right? And this is 50 shares. So if we were looking at buying a full 100 shares in this, you know, you can buy however many shares you want in this particular case, right? But the cost of buying 50 shares is going to be $32,000. I mean, that's a pretty intensive capital investment into a trade. And some portfolio sizes wouldn't support that. So there are some things that we can do to perhaps still take advantage of that directional movement, or maybe we look at a different stock or something like that, right? So we're going to go ahead and we're going to read through this order, make sure that we're aware of that. I'm going to put this in my stocks group, and we're going to click on send here. We're going to fire that order off, and we're going to wait, and price just popped up above that level, and we are into the trade. So there we go. Not a recommendation. It's simply an illustrative and educational example. So, Michael, let's rotate back. I know you mentioned some of the chip stocks. Let's take a look at. I think this is one that somebody had asked about and talked a little bit about, and that was AVGO, Broadcom. In this particular case, kind of doing the same thing. We've got an earnings announcement coming up over the horizon here, the first week of June. Also kind of giving us that little bit of a kind of a bull flat type of perspective here.
It really is. Yeah, it's kind of a common theme with a lot of these semiconductors. In fact, they've had the big run, but Ben, to your point too, they've just kind of flattened out as of late, forming those flags across the board. Yep. This is clearly one that's right there. In fact, you've got a line drawn in there as well, a horizontal line, so we've kind of been holding above that level. Yeah.
Right about that level. The other one in this space that I wanted to look at really quickly here was MU. And again, Micron kind of moving back up. One thing I noticed, and this is, I think, indicative of some of these technology leaders and something that I wanted to talk about, and I know it's something you've mentioned in the market and sector analysis discussion, is the fact that, you know, some of these leaders, some of these what were technology leaders that have started to rotate back into favor and have had these very strong upward moves, have also maybe gotten a little bit overcooked, right? They've run up into these overbought ranges on the RSI, and now maybe running into some resistance areas at slightly lower highs than we've seen in the past. Because the thing that stands out to me is kind of this diagonal downtrend line on something like MU, Michael.
That's right. Look at that. It's holding that. That's a really good point, because how many times has it hit that level? At least 4 or 5 there, Ben.
Right.
And so the ultimate sideways trend is still sideways to down, as defined by that downward sloping trend line, right? Is still intact, is what that's showing me, Ben. And
For
so
sure.
Until we take that out, it could be interesting. I'm also noticing too, just to the right of that, Ben, we're seeing a very interesting number there, 100. Sometimes those big round numbers, you know, the century mark. Yeah,
for sure. And as a matter of fact, sometimes you'll even hear old timers refer to that as a stock trading at par, right? Because 100 was kind of that par value of a share of stock, as those shares. This is, I mean, we're talking way back into the railroad stock days, right? And so you'll still hear guys refer to that when we want to sound cool because they've read about it. I don't know that there's anybody still trading from the old railroad stock days, but who knows? There might be, but you'll hear people refer to that. Hey, the stock's trading at par, and that generally refers to the stock trading at $100. And there's also the mythology, Michael, that there are no $100 stocks, right? The stocks don't like to sit at $100 for very long. They'll either go up or they'll go down from that level. That's all mythology, but it's kind of cool mythology to talk about in the market, and that's one of the things that you'll that you'll get as you kind of enjoy our webcasts and watch kind of the broad variety of experience sets that we have amongst our coaches. I know, Barb's experience in terms of coming to Charles Schwab as a coach was as a student to begin with, and I know that Barb talks a lot about that. You and I have been doing this for a long time. We both come at it from different backgrounds, but it's been an interesting ride to talk about these things on an ongoing basis.
Absolutely, Ben. Yeah, when I threw out that 100, I just knew you'd have something interesting to add to that. That's for sure. There's no doubt.
Hey,
By the way,
speaking
Ben,
of adding something interesting, Michael, I was just going to say, we have a feedback survey out there in the chat today, and this is where it gets really interesting, because this is where we ask you to help us out making these webcasts better. So do me a favor, if you wouldn't mind, just take a couple of minutes. It's a very simple ask. It's a couple of quick questions. We are simply asking you to help us make these sessions better by filling out that feedback survey, giving us your ideas. I don't know about you, Michael, but I read every single one of those comments that come through those surveys. That's how I shape what we do in further webcasts and the requests and ideas that come there. So do us a favor, fill that out. It's really quick. I know sometimes we get fatigue from surveys, but boy, this is a helpful one. Helps you, helps us. And I just wanted to say this as we bring up that feedback survey, that we are very grateful for you as our clients and our audience for being here and for taking the time to follow us, to click on the subscribe button, to fill out that feedback survey as well. And I think I echo Michael's comments and feelings about that too. Yeah.
Absolutely, Ben. Yep.
Hey, let's do this, Michael. Let's rotate back really quickly as we kind of count down our time here, because boy, it goes so fast here in the morning. But I wanted to pop back over here to one other thing. I wanted to take a look at what's going on in the VIX, the volatility index. And this is kind of a measure, if you will, of fear and optimism, maybe is the way to, or complacency, maybe is the other thing to think about, right? The other side of that coin. Fear when we get these big spikes, right? Because it usually comes as a matter of a news event, a discrete news event. Optimism or complacency, because when the market has been moving higher, oftentimes what happens is the VIX falls and moves down to a low. It has, however, though, been staying a little bit more elevated, yes?
It has. Look at that. It a lot of times, Ben, I know you and I have had this discussion, similar lows, similar highs. I mean, look at that. That is a support level. And a lot of times you'll find that you might not see the kind of spike that you got previously, but perhaps you might get a move at that level. But it's a very interesting point. You could see how it might, once it finds these points, these levels, just like it did at 15, Ben, back earlier this year, we held at that 15 level for 2 months or so.
And if you go back over the last 15 years or so, 15 or 20 years, the average VIX level is right in this 15 to 18 handle. And that would just suggest, again, the fact that VIX is a mean reverting instrument. It tends to come back down. When it gets high, it spikes quickly, and then it bleeds off relatively quickly as well. One of the other things that we can look at is the VIX relative to the SPX. And so this is where I talk about maybe that complacency, right? Because the market's been rallying up. VIX has been falling. And now we're at a point where there's a little bit too much complacency, right? A little bit not enough fear of the potential that's out there, because there are certainly things that can happen. And I talk about it in this way. This is the VIX versus the VVIX. This is the volatility of VIX. And the relationship here is this. When we see the volatility of VIX lower than the VIX, that would suggest that institutional participants, not really out there buying hedging products and kind of saying, oh, cool, the sun's shining, but not recognizing that when the sun is shining, that's when umbrellas, protective instruments, are relatively cheap. And maybe that's the best time to buy umbrellas, is when it's not raining, right, Michael?
Yeah, that's a really interesting point. I hadn't looked and compared this chart, but I totally see the logic there, Ben. And you can actually see clearly a few of those points where the VVIX does lead to the downside, and that yeah.
So it's now starting to reverse a little bit. VVIX starting to pick up. Maybe that suggests that there is a little bit of hedging activity going on, as John the Noble Savage points out. Now the Dow down about 300 points. So maybe starting to see a little bit of rotation there. But Michael, I'll tell you what, we've got to rotate back to some other things here today, but I just wanted to do this. I wanted to pop out here really quickly. If you have the opportunity, you want to learn a little bit more about some of these topics, come on over here to our Trader Talks webcast channel on YouTube. Make sure you click on the subscribe button. Make sure you use this search function right here, because you can search for pretty much any topic you want to see, and there's going to be a webcast or multiple webcasts talking about those topics. And then you can always join us over here on Schwab Coaching at schwab.com/coaching, where you have a calendar of our upcoming webcasts, you have on-demand webcasts, and you also have our calendar of live in-person events. By the way, Barb's going to be with me. I think we're going to be in Anaheim next Thursday and Friday, next Friday and Saturday, doing a advanced options virtual or in-person workshop. So some good stuff there. Hope to see you there. Michael, thank you so much for joining me today. This has been a lot of fun. We don't often get to spend this time together on screen. So thank you very much for being here. Thanks to all of you. My thanks to Barb Armstrong, our great support staff as well, Gabe, Andrew, and everybody else that is out there helping us out to bring this to you. But most of all, thanks to all of you. We'll see you guys again soon. I'll be back coming up in about an hour talking about index options. So we'll see you then. Take care, everybody. Bye-bye.